There are two big mistakes that I want to hit on. These are landmines that will just absolutely kill a deal. I think in most transactions, the buyer usually has a little bit more leverage, and the tax rates that apply to ordinary gains are almost twice as much as long-term capital gains. Tax experts out there, they are certain that there actually are no valid S corporations because the rules are very strict and complex. There were no state income tax returns filed in any state, and there were no sales and use tax returns. A conservative estimate of the state tax liability issue was like 15 million. Someone found this in the diligence room. There's this document. We think the S election is blown. It's blown. It's blown. This is terrible.
Hello, everyone. Welcome to another episode of This is M&A. My next guest is an attorney in the Pittsburgh office of Steptoe Johnson, a national law firm with over 450 attorneys. She focuses her practice on federal, state, and international taxes. She's the person you want to make sure that you go to so that you don't blow up a deal because of some overlooked tax issue. She works on middle market M&A deals across industries, usually in the $30 to $100 million range. She splits her time pretty evenly between buy side and sell side M&A. Before joining Steptoe and Johnson, 3 years ago, she practiced at Clark Hill, Cannell Gates, and she also led her firm's work in the Corporate Transparency Act, the law requiring almost all companies to report their beneficial owners to the federal government. Even though the law has been suspended, she believes we will see it come back. Outside of transactions, she's an avid reader and proud mom of 2 kids, ages 4 and 2. This means that when she's not structuring those multi-million-dollar deals, she's negotiating with her toddlers. And let's be honest, that's probably the tougher of the 2 jobs. With that, everyone, please meet my guest, Christine. She loves to go by Chrissy, Christine Green.
Hey, thank you so much for having me. I'm really excited to have this conversation with you. And you are correct that negotiating with toddlers is more challenging than tax law.
Yes, it is indeed. I was negotiating with my toddler last night why she can't have another sugar belt right before bed. So
yes,
it was
we
rough.
have the same negotiations in our household.
Yes. And they tend to win most of them, but the sugar belt before bed, that's a hard no. So
Yeah.
But yeah, so happy to have you. You and I have been chatting for months about having you on the podcast. In fact, we met at I believe it was one of the M&A events. We had a great discussion. Yeah, in Chicago. Great event, by the way. And here we are, and we're finally making it happen. So I'm excited about it. And what we're going to be talking about is one of the most overlooked topics in M&A, and that's taxes, right? It's not flashy, but the truth is the wrong tax move can stall your deal, can kill your leverage, and in the types of transactions you're working on, it can cost people millions, right? So what we're going to do is we're going to unpack, first and foremost, what the brand new Big Beautiful Bill means for deal makers right now and why everyone's talking about qualified small business stock. We're also going to chat through the classic fork in the road that every buyer and seller faces, right? And that's assets versus equity and how that choice changes the tax consequences for both sides of the table. And finally, the hidden tax landmines, right? Chrissy, you've been at it for a while. I'm sure you've seen time and time again in diligence, the ones that quietly blow up your deals or can potentially slash your valuations. And so we're going to talk through some of those items as well. So we have a lot to unpack here. Really looking forward to the discussion. Chrissy, where should we jump in here? Where should we get started?
So we must start with the One Big Beautiful Bill Act, which was the major piece of tax legislation that we had this year. It was signed into law ceremoniously on July 4th of 2025. So we've now been living with it for a couple of months. But it's really critical to understand that piece of legislation when we talk about how taxes impact deal structure, because you have to know, right, what's the latest, what's new, what is the current state of the law. And the One Big Beautiful Bill Act The primary thing that it did is it extended a prior piece of tax legislation that our country had all the way back in 2018, the infamous Tax Cuts and Jobs Act. And so, one of the things I've been saying all of 2025 is when President Trump took office, one of the questions a lot of people had was, okay, what's the new congressional agenda and White House agenda going to be? And what I've said all year is tax. Tax is the agenda. And the reason why Congress was so focused on tax legislation this year and getting it passed as quickly as they could is that the Tax Cuts and Jobs Act, way back in 2018, did a lot of different things, cut some tax rates, put in some beneficial tax rules, but a lot of those rules had what we call sunsets in them, meaning that they expire on a certain date. And the date of expiration for most of those is the end of this year. So the reality is, if Congress didn't do anything tax-wise in 2025, taxes and tax rates were going to go up for a lot of people starting in 2026 because the Tax Cuts and Jobs Act was expiring. So that's why the first half of 2025, every time you turned on the news or looked at your phone, you constantly were seeing things, even in kind of the main mass media, not just tax blogs and things that people like me read, but you were constantly seeing things about, is tax legislation going to go through? What's going on with it? Now we can, people can argue about what's fair and what makes sense. That's not the point of this conversation. But that's kind of the reality of where we are and how we got to the One Big Beautiful Bill Act.
So on that topic, just real quickly on the Big Beautiful Bill Act, I'm sure that was probably causing it just added to the uncertainty, right? In deal making, people wanted to see what was going to happen. Is that what you kind of saw on both sides of the table?
Absolutely. So, again, going into 2025, the M&A market and the tax community, I think people sort of thought, oh, this is quarter one and quarter two, we're going to have a great M&A year. And really what we kind of saw as 2025 has unfolded is that quarter one and quarter two were actually quite slow with M&A activity. And I do think while there are a lot of reasons, I think two primary components to that were uncertainty in the tariff arena, right? We had a lot of different announcements. Even now, we're still dealing with that. And then the second piece of that is there was this tax legislation. We weren't sure, was it going to happen? And there were multiple times in the negotiations when it really just looked like the Republicans were so far apart on it that there was no way that they were going to come to an agreement and also get President Trump to agree with the proposals. And it really, President Trump kind of put in the deadline of July 4th, I think, because, signing it on July 4th looks good. It's easy to remember. But the reality is, like a week before then, a lot of tax practitioners, we were all shaking our heads going, okay, there is no way they're going to agree on all this stuff. But lo and behold, right, deals got made, work got done. And here we are, we do have this fulsome tax legislation. And I will say that, I think in the deal space, a lot of people sort of look at it as like, okay, tax reform, is this really going to impact anything? But it does. And so, there's one provision in particular that we should focus on that really does impact deals. But I will mention a couple of the other things just so you can get a full picture of kind of what was going on in people's heads. So,
yeah. What's the one change, I guess, or headline change in the bill that you feel every CEO or founder should know about?
So the headline change in the deal world is certainly that it's called qualified small business stock. And those provisions in the tax code have been changed to the massive benefit of taxpayers. And so there's a lot of new planning opportunities that go into, if you're going to start a business and you want to think about, should I be a corporation? Should I be a partnership? There's now a lot more that goes into that conversation because of these supercharged qualified small business stock rules. And it also plays into M&A transactions and what an exit looks like and how to take advantage of the new rules. Some of the other big pieces that kind of fit in there as well, we still have a flat 21% corporate income tax rate in the US. That was not changed in the bill. If this bill wouldn't have been passed, the ordinary income tax rate for individuals would have gone from 37% to 39.6%. But in this piece of legislation, Congress basically extended and said, no, we're going to keep that max rate at 37%. And that certainly would have, it's not a huge percentage increase, right? But taxes go up. People don't like it. That can impact in a deal what your tax rates are going to be and what the tax liability looks like. So that's important to know for sure. And then the estate tax exemption, so not on the income side, but for federal gift and estate tax purposes, under the Tax Cuts and Jobs Act, there was roughly $13 million individual exemption, which in simple terms, that means that most people, they're not subject to federal estate tax. When they pass away, their stuff is going to pass on to their heirs. There's not going to be a big piece that gets taken out of it at the federal level because our estate tax exemption was so high. And one of the things that the One Big Beautiful Bill Act did is it basically extended that, but bumped it up even more. So now it's at a $15 million exemption, and it's also going to be inflation adjusted once we get into 2027. And so that definitely is a big impact for, CEOs, owners of businesses, executives, because if you're someone, you own equity in a company, it's worth a lot, and you want to think about succession planning and what things look like for your children. Right now, at this point in time, you do have a very high exemption amount to kind of work with, and you can move things around and do some beneficial planning for your family. So that's, something, maybe not entirely deal related, but what I always tell people is if you do own a company and you're thinking about selling it, you absolutely need to get your estate planner involved and make sure you have a comprehensive estate plan. And if you're charitably inclined and you want to think about giving, one of the things to think about is, do you maybe want to gift some of that equity to a charity if you're able prior to a sale and accomplish sort of your giving goals, but also saving in tax in the transaction? And those are all things that you cannot accomplish them in the 11th hour of a deal. If it's the night before closing and it suddenly occurs to you, hey, I'd like to do this, it's too late. And so it's great honestly, I tell clients that I work with, if you think you might sell even 3-4 years from now, start doing that planning up front. And with the tax law changes we had, it's a great time to do that planning.
Yeah, that's been the general consensus across anybody in the M&A ecosystem is, if you're thinking about getting a deal done, let's start 3 years before and let's start talking to all the right people, assembling the right team. You brought up an interesting point, right? Right now, what we're seeing and what a lot of my guest speakers have been seeing is there's a generation that's aging out that wants to hand their business off to their successors and to their family, and and they don't want it, right? There's that group, but then there's obviously the other group, right, where they actually do want it. And I think what you're signaling to is the timing piece of this. is important, right? Timing of a deal is so critical. And so if I'm a seller about to sign an LOI, how do these new rules affect the timing of a deal? That's one of them. What other, I guess, pieces to this puzzle fall into the equation of how this could affect the timing of a deal, if any?
Yeah. So again, if you're trying to, do some of this planning while you're mid transaction and, the other side is you're negotiating the documents with them, the structure has already been determined, all of those things. If you're trying to do some of this kind of personal estate planning at that time, what's really tough about it is oftentimes a buyer, they're marching toward a particular closing date and they don't want to wait for you to get estate planning in order. So either they'll say, okay, I guess we can wait and it might delay things. And depending on if there's financing involved, right, that might not work. Or they'll just flat out say, look, no, we're doing the deal this way. And if you're not going to want to do it this way, then we're out. Find a new buyer, right? So the sooner you can plan, the absolute better. The other thing that I have seen pop up before too is that, sometimes someone's kind of personal advisor might take a pretty aggressive position on something tax planning wise. And if there is something like that, it doesn't mean that you can't do it or that it's a problem, but a lot of times a buyer, they might say, okay, this seems a little bit odd, or I haven't heard of this before. They're going to want to have time before the closing of the deal to look at what was done. So if you owned, all this equity in your business, but then 6 months before you entered into the LOI with the buyer, you ended up, gifting some of that equity to someone, or you moved it into a certain type of trust, or maybe a private foundation holds it. A lot of times, right, the buyer, they're going to fully want to diligence what you did. And oftentimes the attorneys that helped you do all of that planning are not the deal attorneys. So that will involve having the estate planning attorneys kind of come into the deal and maybe do a diligence call or something like that with the buyer. And that's fine. It happens a lot, but it does add a little bit of time to a potential transaction.
Right. It extends the diligence component. Just out of curiosity, went into effect in July. We're now in October. Have you experienced or had any clients that have been surprised, whether good or bad, right, by how these new tax implications kind of hit their transaction?
Yeah, I mean, I think for a lot of people, it's really just been in the background and they're not even necessarily thinking about it. A lot of times, I always laugh a lot of times when I'm working on the transaction. I always say, I'm the tax lawyer. I'm the last person to know what's going on with the status of the deal unless someone raises a particular issue. But I do think that two things I've seen. The One Big Beautiful Bill Act reinstated 100% bonus depreciation. And so that's been really big in deals where buyers are saying, hey, I'm buying this business, I'm buying all of this stuff, right? This is great. I'm going to get more depreciation deductions than I expected. And we'll definitely dive into asset deals versus equity deals and what that looks like. And that plays a big role there. And then the other thing is certainly, and I mentioned this before, the qualified small business stock. I was working on a transaction that, they were trying to decide structure wise how the buyer, we were representing the buyer. They were trying to decide structure wise how this target business was going to fold into their structure and their businesses. And because the qualified small business stock provisions have just been supercharged, they are laser focused and became laser focused in that transaction on planning directly into that. And so that's where someone like me, you really do have to involve in your deal team because your corporate lawyers might not have as much of a knowledge of what the structure has to look like to be able to get the expected tax benefits.
Yeah, you hit on an important point just to kind of really hit home with is your corporate attorney shouldn't be the same attorney that's running the deal. There should be an M&A attorney as well. That's just, you want to make sure you have the right team, and that's part of that team, right? There's the banker, there's the M&A attorney, there's several other folks that are part of that equation as well. You got to make sure you have a solid, team. We've talked about this in previous podcasts as well, how important having that solid team is.
Oh, it is. You need a village for these
Yeah,
deals.
exactly. So let's just shift gears a bit and let's talk about deal structure, right? Because deal structures are obviously shifting as a result, assets versus equity, and why does that matter? So maybe if you can talk us through that a bit.
So the age-old question that we always get at any deal at the beginning is you've got to understand what is being sold, as simple as that sounds, but you do. And what I mean by that is if you have a target business, you need to understand, is the buyer wanting to acquire all of the assets of that business?
Right.
Or are they wanting to acquire the equity? So if you have a corporation, it holds and runs a business. Are they buying the corporate stock, or are they buying the assets of the business?
And just real quick, just some of my subscribers may not know the difference between the two. What are the assets? Like maybe just give us a little line of sight. Like what's some examples of the assets? What's that look like?
Well, so if you had a manufacturing business and you make a certain product and you sell it, if someone wants to buy all of your assets, then they'll just come in and they'll acquire your facility, they'll acquire all of your manufacturing equipment, they're going to come in, all your office equipment, anything you use to run that business. They may or may not want your employees as well, so they may decide to hire them after as part of the transaction. And then, of course, a big component of any business is really the goodwill. So do you have a good customer base? Is it a good going concern? Do the financials look good? And that really goes to someone's value and their goodwill. So from a legal side, kind of setting tax aside for just a minute, a lot of buyers, just for plain legal purposes and risks, they have a tendency where they would like to buy assets because, and oftentimes, right, they can pick and choose which assets they want. And it really reduces their risk, where if they come in and instead of buying all the assets of my fictional manufacturing company, they acquire the legal entity, the corporation or the partnership that owns that business. When you acquire the equity, the corporate stock, the partnership equity, whatever it may be, you can't pick and choose which assets and which liabilities you end up taking. You're taking it all. And so just for general legal purposes, a lot of times buyers will say, like, hey, as a matter of policy, we only buy assets, which usually isn't true. It just depends on the deal. But a lot of buyers kind of come in from that perspective, that for them on the legal side, there's just more risk if they're going to buy equity.
Right. That's an interesting perspective for sure.
Yeah. Now, that's not the full picture of what's going on, though. There are other times when the business might have a important license, like if they have to have certain government approvals to do what they're doing. So if you think of particularly businesses in the healthcare industry, this can be really critical. And it could be at the federal level, or maybe it's a particular state type of licensure that they need. Cannabis would be another area, right, that has these very specific licensures. Those types of transactions, a buyer might say, well, as much as we would love to just buy your assets, we actually do have to buy your equity because the license is tied to that equity. And in order to make sure that we have the license to continue operating and running this business, we don't want to deal with trying to get it transferred to us. So we're just going to buy the equity so that we know we have it. And so that becomes a consideration too. And again, those are non-tax considerations, but they are important.
You hit on briefly that a buyer will often want an asset sale. I guess then is the competing side, the seller typically wants a stock sale? Or is that a typical battle that you've seen, and who ends up winning typically that battle?
So yes, so a lot of times a seller might be more inclined to just say, just buy my equity. But really, the primary driver of that for the seller is the tax side of it. And I will say that I think in most transactions, the buyer usually has a little bit more leverage unless you have a seller that doesn't really care whether or not they sell their business, right? Maybe they went into the M&A process just thinking, hey, this would be great if I could sell, but if I don't, it's not the end of the world. But in an instance where a seller is like, no, hey, I'm ready to retire. My family doesn't want this. I need out. I'm planning on doing things in my life. I'd like to have the money, the sales proceeds. In that case, a lot of times the buyer has the upper hand and they're really going to be the one that drives the structure. But there are things sellers can do, right? So I think we should take a step back and talk about why would a seller prefer a stock or an equity sale? And the reason is that a lot of times when a seller sells their equity in a business, for tax purposes, their gains in the transaction end up being what we call capital gains, and more specifically, long-term capital gains, because they've held their equity for more than a year. And conversely, if they just sell the assets of the business, a lot of times the type of gains involved in the transaction, rather than being mostly long-term, end up being what we call ordinary gain. And the tax rates that apply to ordinary gains are almost twice as much as long-term capital gains. So a big component to this tax strategy from the sell side is you want to get as much of the gain in the transaction into the long-term capital gain bucket versus ordinary to lower the tax cost for the seller in a transaction.
No, that's a good point to make for sure.
Yeah. And I will say that this is a general rule of thumb. There are instances when someone could actually be better off selling assets. It could be that maybe they have a loss position in their assets. They might have a really, really low tax basis in the equity of their business. And so they're actually better off selling stock. But it is kind of a threshold question in every transaction. Are we going to sell the assets? Are we going to sell the stock? And what does the tax picture look like for the seller?
From my experience, when we do thousands of obviously deals in the data room side, and we have lots of conversations and understand a lot of these deals as well that we're involved in, I would venture to say oftentimes what I see is exactly what you described. Buyer has a little bit more leverage. Now, there are a set of sellers who are like, hey, I got strong financials, strong everything. I'm fine holding on and not selling. There are those, they're out there, that happens. But I would say the majority are buyers have more leverage in the deals. And so with that being said, what advice do you actually give to a seller to maybe avoid being steamrolled on this particular choice, right? If they're between equity or between assets. And maybe this is an investment banker question. But if you have any insights on that, of what you've seen where sellers were able to kind of stand up and say, hey, no, and drive that ball forward so it leans more heavily towards the direction they're trying to go. Have you seen anything in some of the deal structures that really stood out?
Yeah, there are several kind of tools in our toolkit that we can use. So the very first thing is, a lot of times the LOIs that I see, unfortunately, don't say anything about the structure of the deal, or it's very vague. And so one of the things that I like to do is if I get brought in on the early side of a transaction, which is great, where we're still negotiating LOI terms, you want to make sure if you're a seller that the LOI section or paragraph that talks about the structure of the deal has something in it to the effect of the parties will work together to make this tax efficient for the parties, and you want to preserve the right to a seller getting what's called a gross up payment. And a gross up payment is basically where if the buyer is demanding a structure that places a significant tax burden on the seller, the buyer basically has to pay the difference or bump up the purchase price to cover that for the seller. So, and that's something that, I think investment bankers are now a lot more familiar with that than maybe they were a decade or so ago. So even now when you maybe don't have lawyers involved on the LOI, I am seeing investment bankers, advising clients like, hey, we should put in something that kind of preserves this issue. And that's kind of the threshold first issue is ideally you want to have it in the LOI so that way you can at least go back to the buyer and say, wait a minute, you knew this was a possibility if you're requesting some kind of structure that's more expensive for us.
Just real quick, I just want to take a step back just for the listeners who might not be familiar with some of the M&A lingo that we're using. LOI is letter of intent. It's typically it's a pretty it's one of the first binding documents that they're going to be involved in if they're looking to sell their business, right? What you just described, it kind of reminds me of my real estate years going back 15, 20 years when I was doing a lot of real estate. What we would do is we would structure deals for purchases of houses where we would say, hey, we're going to hold back. You're going to give us X amount at closing so that it would pay for all of the closing fees and everything like that.
I will say that there's no cookie cutter solution to that. I mean, every deal is going to have its nuances. Sometimes buyers will say, fine, we'll call it a gross up payment. Other times buyers will say, well, we're willing to come up on the purchase price, this much, that should cover it, but don't ask us for any more. So it really just depends on the specifics of the deal. One of the other tools that I always like to have, and maybe it's more of a data point and less of a tool, is a lot of times at the letter of intent stage in a deal where you are talking about this, you're talking about structure, everybody's talking in kind of abstract generalities about it. But what you really need if you're a seller is you need to have a tax attorney and your CPAs or one of them, whoever is capable, do an actual calculation. Get a good estimate. It's not going to be perfect, but get a good estimate of what that differential is. Say, I want to know if I sell all my stock in this business, what's my tax liability? If I sell all of the assets and then I want to take out all of the cash, what's my tax liability? Because until you know that data point of that difference and the magnitude of it, I think it's difficult to negotiate for something because a lot of people, right, they love to use the phrase, don't let the tax tail wag the dog. But it is true because, if it turns out that if it's a $50 million transaction purchase price and the difference tax-wise between an asset sale and a stock sale is only, $150,000, you kind of have to look at that as a negotiating point. It's like, how much of a stickler are we really going to be? Do we want to get this deal done? But you can imagine, right, where the purchase price, when it's much smaller and you have a large differential, it becomes a much more important negotiating point. And so I always look at it as, yes, we absolutely will put the language in the letter of intent and have it in there. But then once we get beyond that, let's get some actual numbers and get a good estimate that we're comfortable with so that if we need to go to the buyer and really push on this, we know exactly how big of an issue it is.
Right. So we've kind of hit on the next topic. So just for sake of time, let's shift gears again. Um, but the other topic we're going to talk through was tax due diligence and some of the hidden landmines that you want to try to avoid. And you've kind of hit on some of that throughout our whole dialogue. But what are some of the landmines maybe that you haven't hit on that our listeners should be thinking about? What are some of the mistakes that you've seen that sellers have made when it comes to tax diligence?
There are two big mistakes that I want to hit on. These are landmines that will just absolutely kill a deal. So the first is S corporations. So a lot of businesses are structured for tax purposes as an S corporation. And an S corporation is kind of like a hybrid tax legal form of doing business. And so what I mean by that is that under our tax rules, S corporations are what we call pass-through businesses. And so partnerships are pass-through, sole proprietorships or single member limited liability companies, those are all pass-through. And that means that the business itself, that legal entity that holds the business, does not pay income taxes in the entity's name. All of the tax items and the activities of the business flow through to the owners, and the owners pay tax on their share of whatever's going on in the business. And so it's very beneficial from a tax perspective to be structured in a pass-through form. However, S corporations,
Is that more common in a small, like a certain segment, small business versus mid-sized business versus enterprise?
So I think honestly, it's more common than operating outside of the pass-through regime for any size of business, with the exception being, once you get into publicly traded entities, you're going to see corporations. You're not going to see partnerships or S corporations. But I mean, I would say, you think of a $100 million deal or even a $300 million deal, there's still a very good chance that the business is operated in a pass-through form, even at that level. And S corporations, though, while they have all of that pass-through treatment, they are also, under the tax rules, still treated like a regular corporation in a lot of ways. And so there's a lot of strict requirements with S corporations. One of them are everything has to be pro rata among the owners. So if you have an S corporation that's maybe owned by, 3 sisters or 3 brothers or something like that, anytime you make a distribution, it all has to be pro rata. You can't say I'm going to send money out to this owner but not the other 2. You can't have different types of equity. There can only be one class of stock. And there's a lot of tax rules that go into it. And what's a challenge is that there are tax experts out there that, when they present on S corporations and give updates of rules, one of the jokes that they often make is that they are certain that there actually are no valid S corporations because the rules are very strict and complex. And so if you actually completely pulled apart an entity and said, are you following all of the S corporation tax rules, the IRS would find that there isn't one in the country. There just isn't. And I don't know that that's actually true. I think there probably are a few, but the point is well taken that it is very easy for buyers in due diligence to find issues with the validity of S corporations and whether they have followed all of the required tax rules to be an S corporation. And when I very first started practicing law, this was always one of the things that would come up immediately in a transaction. It was, hey, the target business is an S corporation. We have to vet this. And one of the things that the senior tax partners would always say is they would say, oh, someone found this in the diligence room. There's this document. We think the S election is blown. It's blown. It's blown. This is terrible. And when I very first started practicing it, I'm like, okay, what happens when the S corporation is blown? Like, is there an explosion?
that was
Like,
my next question.
What is so bad? What is so bad about this?
Yeah.
So what is nothing immediately happens that's bad.
Especially then given what you just said, which is almost every company's not following, right? So
exactly.
Yeah, I guess you can blow them all up.
Yeah, it's like, why is this so bad? What's going to happen? And the reality is there's not an immediate tax that's due, but the problem is when an S corporation is not following all the rules and it loses its S corporation status, it becomes what we call a C corporation. And C corporations do not fall under the pass-through regime rules. So C corporations, we always say, have 2 layers of taxation. So the first layer is that the corporation itself pays tax on all of its activities. And then when the corporation distributes out money and funds to its shareholders, the shareholders also pay tax. So most tax practitioners, unless you're specifically planning into a C Corp structure, avoid it like the plague. Sometimes it's beneficial, but a lot of times it's more expensive to run an operating business under a C Corp structure. So if your S corporation, that's your target business in a deal, has an issue with this S election and there's a question, it very well could actually be a C corporation, which means that, any distributions it's made are now taxable to the shareholders. So the shareholders haven't paid taxes. It has been filing the wrong type of income tax return. So there could be penalties associated for failure to file returns. Then there becomes a question of, can we cure the S corporation election, or is the buyer going to take what I think is usually a ridiculous position that, no, you need to go back and file C corporation returns. It can impact the structure of a transaction. And so what I have seen in my practice is that anytime there is an S corporation as a target company, which is a lot, the buy side the diligence on that is going to just be under the microscope, really close look at the S election. And if they find any issues that are significant, it can really impede the deal. It'll slow it down. There might be additional escrows involved because maybe the buyer says, well, we want an additional time frame on the escrow in case the IRS discovers this, or we think you should have to go back and amend tax returns or something like that. And so there's a lot of negotiations and things that come up when you have a blown or a busted S election or something that deals with the S corporation status. And so that comes up in a lot of deals.
Interesting.
Yeah.
My wheels are turning. I have so many questions on this, but because of our time constraints, we're not going to be able to dig deep into some of my questions on it. I feel like we could probably do a whole podcast on just S Corp versus C Corp and talk through all of that. There's a lot there.
Absolutely. The other thing that I'll mention on the diligence side is state taxes and sales and use taxes is a huge diligence issue in deals. In fact, in a deal, there'll be legal due diligence calls, which will include tax, although sometimes tax is done separately. And there'll be a ton of questions, and there are always more questions about state taxation for the target business, because it's really easy for target businesses that, have customers in different states or, employees in different states. It's very difficult to be compliant tax-wise in all of those states. And so certainly I see that pop up in diligence all the time. And again, that can impact escrows, that can add, specific indemnification provisions that a buyer might want in a deal. And I'll give you an example where this actually killed a deal once. I was working on a like 100 million, give or take transaction. So pretty sizable mid-market deal. And it was a Canadian company that had a US subsidiary, and the US subsidiary was selling a lot of product to customers all over the US. And there were no state income tax returns filed in any state. And there were no sales and use tax returns. Like the Canadian company, like they set up the US sub and they just didn't really understand or realize that there were all of these added compliance issues that come with that. And I mean, a conservative estimate of the state tax liability issue, it was like 15 million. I mean, it was massive. And so that killed the deal because the buyer was just totally uncomfortable with the liability there and felt that it was big enough and large enough that it wasn't going to go unnoticed. And so one of the things that, we kicked around was a lot of times states have voluntary disclosure arrangements where you can go to them before they catch you and say, hey, I'll raise my hand. I screwed up. We didn't do these returns. We didn't pay this tax. But the reality was, even to do that, right, was going to be a massive amount
it's a big
of
lift.
money.
Yeah.
And so it just wasn't going to work out for the parties. And so that completely killed the deal. So if you are thinking of selling your company, one of the things you can do tax-wise to kind of get yourself in a good position, have a chat with your tax return preparers and say, hey, I want to talk about state nexus and make sure that we are reasonably doing what we're supposed to be doing in the various states, because it's very easy, think about your business is growing.
Yeah.
And maybe last year you only had, 2 customers in California, but now you've got 100. And does that change tax liabilities and filings and what you should be doing?
Yeah, I was in a position once where I went hiring like crazy and wasn't even thinking about where people were located. And I wish I would have talked to my tax people before I started before I went down that path, because the tax implications, right? I didn't think of any of those things until I saw the bill, right? And it was like, oh, maybe I wouldn't have hired in 10 different states. It was when everybody was going remote, and it was like, we want more workers. It doesn't matter where they're at. And it actually does matter,
I always say this too, especially with remote workers. It's a big issue where it comes up. But the reality is, like, a lot of tax rules have not caught up to today's technology. So a lot of times people say, this isn't fair, this doesn't make sense. It's like, listen, the tax rules are not yet caught up to the fact that you can work from anywhere a lot of the time.
Yes, very true. Well, listen, this has been great. Now let's just kind of pivot for a minute here again, and let's just talk about you. I'm interested to understand, where did this interest come from, right? Like, did you know when you were a kid, hey, I'm going to go into tax? Or did you reflect back into your childhood, or like, where did this come from? Did you have a mentor? How'd you end up going this direction?
I guess in a way, tax kind of found me, but it all worked out. So I had, maybe not as a kid, but as I got older and, thinking about college and careers, I had planned on kind of going the CPA route was what I wanted to do. And so I did accounting in undergrad, and that's kind of what I thought. And then when I was in college, I kind of pivoted gears and started to think about law school, and ultimately decided to go to law school. And, as good fortune would have it, the law firm that I interned for while I was in law school, they sat all of the interns down one day, and they basically said to us, they're like, listen, there were 12 of us, and this was a big law firm, and they said, listen, we need one of you to basically, after you graduate and take the bar exam, to come back and be in our tax group. Like, we just need somebody for that. And at that time, you know, we didn't know yet whether we were going to be rehired. They were just trying to figure out what people were interested in. And so out of the 12 of us, everybody was like, dear God, not me. I don't want to do tax law.
They're like
But
deer in
I was
headlights, like,
I raised
no.
my hand, and it worked out because I was genuinely interested in it. But at the same time, I raised my hand because I was like, well, I'm in the category of I need a job after I graduate.
Yeah.
So,
12 hands down and 1 hand up. You got it.
yes, exactly. And so that's kind of how I fell into it. And the firm that I was at the time was large enough that the nice thing was that being in their tax group meant that all of the legal work that I did was tax specific. A lot of times at smaller firms, someone will say like, oh, I have an interest in tax, but they might not have enough of that specific legal work that you kind of end up doing a little bit of everything, which is good and has its positives. But I really got to immerse myself, and I had a great mentor that I talk to on a regular basis today. And it's definitely an area of the law where it's nice to have a mentor.
Yeah. So you started in tax. So that's what you know, that's what you've lived, that's where you've got from cradle to grave, that's where you've been. So that mentor, I just want to touch on that really quickly and we'll shift gears again. Because you're still heavily engaged with them, constantly, working with them regularly, and they're still mentoring you, have you told them thank you?
Oh, yes. Oh, yes. Absolutely. I mean, I joke with him constantly about, I always say, thank you so much for answering every dumb question I've ever given you about how something works or why this rule is the way that it is.
Yeah. I could tell you I have some great mentors myself. I would say my most recent mentor is good old ChatGPT. Even preparation for this discussion, ChatGPT was my best friend because tax and legal are not my two strengths by any means, as I signaled to you previously. So,
that being said, be careful though using ChatGPT for tax advice because we test it from time to time just to see, and a lot of times it's just wrong.
It's still not there.
It's based on outdated information, and tax changes so quickly.
Yes. Yeah. Well, I always said you still need human oversight over AI. That's just the reality of it. We haven't got to the point where, and I don't know if we will ever get to that point where it doesn't need that oversight by any means. So tell us about, how do people get in touch with you? And why should they get in touch with you? If you don't mind just sharing some of your contact information.
Yeah. So probably the two easiest ways to get a hold of me. One is find me on LinkedIn. I'm very active on LinkedIn. I love posting tax law updates. I love when people comment on them and can have great discussions. I respond to DMs. So I'm on LinkedIn, easy to find. And then in addition, I'm always connected to my email. So my email is christine.green@steptoe-johnson.com. So feel free to reach out to me via email. And really, I mean, if you're someone that is trying to buy or sell a business, what I do is let's do it in the most tax efficient manner as possible.
Perfect. And I'll make sure, obviously, that we share as much of your contact information. With all that being said, I loved our conversation. I learned a ton from it. I appreciate the fact that you broke this down to a level that I think our listeners are going to be able to understand and it'll resonate with them. So there's a lot that we didn't get to unpack. As I mentioned, just going from C-corp to S-corp and vice versa, that could be a podcast in itself. So I'd love to welcome you back on the podcast, and we'll get you back in the seat and we can talk through more of the tax and legal side of it.
That would be great. Thanks so much for having me. And yes, there's the S corporations are definitely worth an entire podcast on their own.
Well, that's a wrap on another episode of This is M&A. I look forward to seeing you on the next episode. Until then, stay sharp, stay deal ready.
If this episode sharpened your thinking, share it, post your take, follow the show, or drop a quick review and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.